Welcome to Markets Now. I'm Michelle Rook with Darin Newsom, Senior Market Analyst with Barchart. Well, the livestock futures higher except for live cattle futures this morning. And over in the grains, kind of a mixed affair. You've got soybeans lower, wheat higher, corn kind of steady, stuck in the middle. But Darin, let's start off talking about the wheat market. It was the price leader yesterday. It's the only one up here today, or at least currently. Are we putting in a little bit of war premium, or is that just short covering?
To me, it looks to be short covering, with all that's going on over in the Black Sea. We haven't seen a fundamental shift in these markets yet. Base is still running neutral to weak pretty much across the board. We've got future spreads neutral, also neutral to bearish, again, pretty much across the board. So, this doesn't look to be a big fear of, oh no, the world's going to run out of wheat, all this and all that, even though that's what some in the industry are talking about. Fundamentally, and our reads on real fundamentals just aren't indicating that. So, given that funds had increased their net short futures position as of a week ago today in all three wheat markets, I think we've just got some short covering. And, this is caused by uncertainty. I mean, so is it risk premium being built in? Is it this? Is it that? It could be all of the above. But bottom line is uncertainty creates, short covering. They're most likely profitable on many of these positions. It's time to put some in the pocket, maybe move to the sidelines in wheat and see what develops. I mean, when Russia's Putin starts talking again about using nuclear weapons, maybe the sidelines isn't a bad place to be.
No doubt. We did have better winter wheat ratings yesterday. We've seen a big improvement in moisture in a lot of areas. And so whether you think it's too early or not to even trade that, some of the market participants do. And so that's going to be a little bit of a headwind here in terms of recovery, though, isn't it?
Time has shown that winter wheat crop ratings in fall are pointless. I think we all know. I think most folks understand that. At least those who follow the actual fundamentals in the market. And if we look out, what we've seen is the July-September Kansas City future spread is covering 74-75% calculated full commercial carry. So again, the question is why? Well, as you mentioned, we've seen rains develop over the southern plains. That's a bearish factor heading into the winter, much more so than crop ratings. And we've also seen the cash index for hard red winter wheat continue to drop, meaning available stocks to use continues to grow, particularly after the election, after the U.S. presidential election, meaning, sanctions are going to be lifted sanctions against Russia are going to immediately be lifted. And, none of this bodes well for the U.S. wheat markets on the global stage. So we've got an increase in available stocks to use. This is going to carry over into new crop. We've got better weather for both the U.S. Southern Plains and Midwest. Yeah, so I think there is a fundamental shift going on, but it doesn't have anything to do with crop ratings at this point.
Okay, let's talk about the corn market. Like I said, it's pretty steady this morning, kind of trying to follow wheat, but kind of held back by the soybean markets. You get that tug of war, but you've got the funds now long in the corn market, and demand has been much better there. Mm-hmm. Does that demand continue to hold up this market and push it?
Short term, I think it does. And what's really fascinating to me is watching national average basis, watching basis levels in general. What we're seeing is that national average basis is still running neutral to weak, so near its 5-year, between its 5-year average and 5-year low weekly closes, but it's following the seasonal pattern for when the basis market is strong. And so this is an interesting combination in the fact that we know that there's still plenty of supplies. We can tell that by the actual level of basis, but the pattern is indicating a tightening situation, a tighter situation, meaning that we're seeing stronger than usual demand for this time of year. And again, why would that be? Well, most of it's coming from Mexico. And why would Mexico be buying? Well, they're a little concerned about what's going to happen once the calendar page turns to 2025. So not only are they doing some buying, they're getting some, corn on the books, but they're also shipping those purchases that they're making. They're trying to get as many shipped here before the end of 2024 as they can. And then, chaos ensues. So I think it's a fascinating watch. I think it's a fascinating read on at least the short-term fundamentals of the market.
Now, The December contract, though, has not been able to effectively get above and close above the 435 area. What would it take to get us above that area, do you think?
Yeah, this is interesting because as you mentioned, we've seen a good deal of non-commercial buying, and as you said, I mean, they added 70-some thousand contracts last week alone. It was a huge round of buying for funds, but yet, the
And in
market's
fact, we
just
were lower for the week last week,
yeah.
Darren.
I know. And so if we've got support coming from the commercial side and we've got buying coming from non-commercials, the market can't move. And so this goes back to, again, another one of my rules, rule number 5. I think it's maybe it's 4B. A market that can't go up won't go up. And so we have to be concerned. We have to be a little bit careful with corn in here. What it's trying to say. So, we've got this short-term demand. We've got this short-term push in the market, but longer term, there still seems to be some concern. Maybe we'll see it break free. Maybe we'll see it finally break out of some of these price ranges that corn likes to trade in. But we'll see. We just haven't seen it yet.
And the soybean market down today. And I guess I was surprised we even had a rally after the election because there's so much fear about tariffs after the Trump administration takes office. But we also have South American weather kind of pressing on that soybean market or holding it back too, don't we?
Yeah, I think it's a double-edged sword. You're exactly right. Now, short term, I think this is where the support's coming from again, is short-term demand. We're seeing it from China. We're seeing again some from Mexico and other parts of the world, other buyers in the world. So they're doing some short-term buying. They're getting it moved as quickly as possible. But long term, they know that there could be problems for the U.S. soybean market, and it boils down to Mother Nature and South American weather. The U.S. has become a secondary player. It became a secondary player back in 2018 with the start of the trade war. And this is only going to intensify. We're going to see, and again, more trade war talk. We're going to see more tariffs put in place against other trade partners. More than likely, more trade agreements broken in the very shortly after the turn of the year. So all of these things could eventually weigh on the soybean market. And most likely will. And then we have to hope, the conversation turns to domestic demand and all of these crushing plants that are going up, but early signs, and maybe a little bit premature, that the hopes built on, increased U.S. crush demand could be short-lived.
Yeah, because of the Trump administration's pick for EPA administrator and what else? Why are you feeling that way?
I think that's the biggest thing. Number one, the Trump administration 2.0 doesn't really have to concern itself with U.S. ag anymore. It's been elected again, so it can turn its attention to other aspects, and we know it's more petroleum friendly than anything else. And certainly the EPA nominee is a reflection of that. It's not necessarily interested in renewable fuels. It's more interested in the petroleum as a whole. I think we can expect more handouts of hardship, quote unquote, hardship waivers to refiners, similar to what we saw the first time around. So I think these are all hurdles that the U.S. Soybean and to some degree corn industries are going to have to get through over the next few years.
The biofuels industry is in your camp in terms of their concerns as well. In the meantime, we were talking about tariffs, China, Brazil, announcing an agreement, an export deal tomorrow. And that is kind of just basically pointed at the United States, kind of snubbing us, isn't it?
Yeah. I mean, that's the bottom line. I mean, it's interesting, 2 weeks after the election, it's what we're going to see. And really, to anyone who's watched these markets, it should come as no surprise. We know the alliance between China and Brazil has strengthened over the last number of years. And I go back to a U.S. Soybean Export Council meeting that I had the opportunity to attend back in 2018, when one of the analysts who closely watches China said at the time, China was doing the math, doing the paperwork to buy only what it needs, the absolute minimum from what it needs from the U.S., and everything else was, as much as it could, was going to be pulled from Brazil. And that's exactly how it's played out. And, with these new announcements of stronger alliances and everything else, we can look at BRICS, where, Brazil and China make up at least 2 of the 5 countries that are initially talked about in that title. We know there's a strong alliance, and it's only going to increase. And, let's add to that At the most recent Barchart conference that I went to this past September, we had a specialist, we had an analyst from South America and Brazil on the panel, and he said Brazilian production in all grains is expected to double over the next 11 years. That's very sobering for the U.S. industries.
Yeah, it is. So you believe most of this business that we've been seeing both in corn and soybeans is front loading. So what happens after the inauguration? Does it completely dry up?
That's the key question. Theoretically, it could, but again, it comes back to whether these markets are weather derivatives. Thankfully, that could be the saving grace for the United States industries as we head into the latter parts of winter and early spring 2025. Is that if there are weather problems in Brazil, if production of corn and soybeans isn't what is expected or what is needed from some of the world's largest buyers, then business could continue to come to the United States. I mean, we've seen corn future spreads, all of them, working towards that bullish line of 33% calculated full commercial carry, and that's an interesting development to me. We aren't seeing it in soybeans, but we're certainly seeing it in corn, and so that tells us that the commercial side is thinking that there could be some problems, particularly in the Brazilian corn market or corn crop, that could keep interest here at the U.S. Longer than expected.
Yeah. Let's kind of sum up or round out here on cattle, because we had a higher day yesterday in both live and feeder cattle futures, but feeders have undoubtedly been the leaders. As we speak here, we're starting to see the live cattle market try to follow the feeder cattle market, but you've got lower cash, lower boxes, and the seasonals are lower. So what wins out here in the end, do you think?
Fundamentals win in the end. And right now, as you mentioned, we've got fundamentals going a couple different directions. But in the live cattle market, as you mentioned, we've got boxed beef going down. We've got the cash price seemingly stuck and starting to weaken a bit. We've got future spreads where nearby contracts are losing ground to deferreds. None of this is bullish fundamentally. And so, we could certainly start to lead to increased pressure, particularly if the fund side of the market starts to throw into the towel. Remember, they're still holding a net long futures position in live cattle. The feeder cattle, live cattle equation just simply doesn't work at these levels. So, the question, obviously, as you mentioned, becomes how long can this last? How long can we continue to see the market push feeder cattle higher and live cattle not really doing much of anything, and then still try to make a bullish fundamental argument? Because at some point, demand's going to simply dry up because packers and feeders simply can't make this work.
All right. Thanks for joining us, Darin Newsom, Senior Market Analyst with Barchart. That is Markets Now.